Hi everyone, and welcome to our ETF video for the week, and we're talking about hedging the top stocks in your IRA, and this is all new news coming out of Charles Schwab. So folks, you want to see what this is all about, getting on toward the end of this. But first we're going to go into what the ETFs have been doing this week, and because don't forget, we had a terrible sell-off on Wednesday, and now the market is trying to regain some of those losses. And remember, if you want to live on this beach like Jimmy Buffett did, you've got to learn how to invest even better than Warren Buffett does now. And let's look at the S&P 500, and we can see that we went down kind of in the middle of nowhere. This blue line is the 50-day moving average, red line is the 200-day moving average. Thought we were going to go down to that 200-day moving average, but we didn't quite get there, and then we got a buy signal up here. So we'll see what happens, folks. But this is a nice little buy signal, but we're waiting for this intermediate term indicator to turn up, and it looks like it wants to turn in here, but we'll see. And let's get into some of the ETFs. This is the technology ETF. You see the same type of buy signal up here. Exactly, it looks very much like the S&P 500, and we can see that it wants to turn up down here. Let's look at the semiconductor. The semiconductor is neat because down here, this intermediate term indicator has turned up if it can close. Now, I'm recording this on Friday before the close, so we'll see what happens today. But this looks very good in here. And we're approaching its 200-day moving average from the underside, and we've got to get through that. There's plenty of resistance right there. We want to get through that, and we won't know till Monday or Tuesday. And when we look at the transportation, same type of thing. Nice buy signal in here. That's called a divergence. When the market makes a lower low and the indicator makes a higher low, that's a divergence. Again, we're above the 200-day moving average here, and we are testing that as we speak. And down here, it looks like we're going to get a crossover to the upside, but we want to see that, and that will let us know that the market is in pretty good shape, at least for a while. And I get so many questions over which ETFs do we use in order to pick the top stocks from those ETFs, and then if we hedge, we go short the ETF itself, but we're long 5 or 6 or 7 stocks of the best stocks in that particular ETF. Well, this is a 5-year chart. Black line is the S&P 500. So we look at ETFs that are close to the S&P 500 or above it, because if we pick the top stocks in those ETFs that are already outperforming the S&P 500, we're going to have some pretty good stocks in there. And of course, what we have is a semiconductor up here. The next line is the technology, and then we have the home builders in here. This orange line and this gray line down here are home builders, and or have something to do with the home building industry, the materials, and another one's the home builders. And right in the middle is the technology ETF. So home builders are pretty good, folks. The thing is that they can overreact when the economy's not good, so they're much more well, everything's cyclical when the economy's not doing very well. And then down here we have the health. The blue line down here is the health, very close to performing as well as the S&P 500, and this yellow line down here is the transportation. Let's look at 10 years, and they're all doing as well as the S&P 500, again, black line, or better, and the only one that's below it a bit is the transportation. But the transportation follows the S&P 500. In fact, the transportation is watched by many technicians because if the transportation doesn't move, that means the economy's not moving. So raw materials have to be transported, and the finished product has to be transported. So that's a gauge of what's going on in the economy. And we've gotten some good results out of that transport ETF, by the way. And let us look at some of the ETFs that have not outperformed. This bottom one is the oil. And this blue line here is energy. Black line again is the S&P 500. So up in here, you have materials, you have industrials, you have finance, you have consumer discretionary. So you have a lot of ETFs that are close, then this is 5 years, close to the S&P 500, but we would rather pick ETFs that are above the S&P 500, even though our research has gotten good results out of these ETFs. And when we pick the top stocks in an ETF, they have, over any 5-year period, they have always outperformed the ETF itself. And we've done a lot of research on these ETFs, believe me. Now, okay, let's talk about those IRAs, because how do you hedge the top stocks in an IRA? Well, you can use an inverse ETF. Since you can't go short in an IRA, you can use an inverse ETF, which operates the opposite way of the ETF. So you can buy an inverse ETF, which is like shorting the ETF outside of an IRA. And what you can do is, since you have to use money for that inside an IRA, you get a 3 times the inverse ETF. So you use about 25% of your money to buy the inverse ETF, and the other 75% you can go long the stocks. And now you can also, with Schwab anyway, you can use spreads, and we use spreads just to generate enough money to pay management fees. So that's very, very important for you folks that are saying, I don't want to pay 1%, or I don't want to pay 1.5%, or even 2% in some instances. Well, we use spreads, or spreads can be used. We suggest in our newsletter, you use spreads, and you gain, and you do it just a couple of times a year, just enough to make enough for that pay the management fees. Now, of course, the money manager has to be up to date on using spreads, but they're pretty easy, especially if you follow our letters. So the money managers that follow us do use spreads, because we talk all the time. They talk directly to me and they say, okay, should we put the spread on yet? I send out a message to all of them saying, okay, this is the time to put it on. Again, only a couple of times a year, so their fee can be paid without using the appreciation within your portfolio. So you don't have to worry about that. So again, this is just new, folks. This is new over just a couple of days, because we were getting the news right after the meeting with Schwab was done. We called the Schwab people, the trading desk, and they are now allowing inverse ETFs, but there has to be a warning. The people have to know that there's some risk in inverse ETFs. Reason? Because just think about, if you use a triple inverse ETF, the money managers that are using those or constructing those inverse ETFs are using options for that. And the inverse ETF doesn't always exactly follow the ETF or the inverse of the ETF. So they want you to be aware of that. But of course, most people don't understand that. And why should you have to? That's where the professionals come in. And we've been using inverse ETFs for many, many years now. And if they're used properly, and it's hard not to use them properly, but if you use them and you know the drawbacks of them, it's not a problem at all. You don't even know it. The client does not know it. Most money managers don't see any difference at all. So bottom line is, yeah, you can start hedging IRAs now with inverse ETFs, and you can use spreads in that. And this is all new with Schwab. Most of the brokerage houses don't want you to do it. They don't want the responsibility. They don't want to hear people yelling and screaming, but that's their prerogative. Schwab does allow it, and we had the inside, I don't want to call it inside information, because they had just finished that meeting, and we were on top of that, and we called the people that we know there, and it's allowed to be used, and we love it, because a lot of people, as you get older, it's your IRA that has been building up, and that's what you want to hedge. So yeah, we can do that, folks. Or we put it in our newsletter, and money managers that follow us do use that. And I just want to show you here something here the other day. Now, the other day, which was around the 9 of 27, so we're looking at September 27th, and it was Wednesday, we had a drastic decline, and I took these numbers right at the bottom of the market. The Dow was down over 350 points, and I took these numbers from, in this case, the 1st of September, and I want to show you something here. And these are 6 of the ETFs that we use, and many times we use just these 6, but we use some of the other ones that we just went over in one of the slides. So what I want to show you is that the top stocks in these ETFs, now I took some stocks out of here, but the bottom line numbers were frozen so that these numbers are correct. Even though there's 6 or 7 stocks in here, I took some of the lines out. I froze the numbers and then took some of the lines out so we can fit all of them on one slide. Because, okay, so between September 1st and September 27th, at that bottom there, the top stocks went from 42% down to 29%. So we're looking at about a 12% decline, almost 13% decline. But if you were hedged, you only lost 1.7%. So 13% you would have lost if you had the top stocks. Now don't forget, the S&P went down 7% in here. So, but if you were hedged, you lost 1.7%. Over here, you actually gained 0.4%. And let's go down to the semiconductors. The semiconductors were down about 7% in here, and this is from the 15th through the 27th of September, just a couple of days ago. And we lost, if you were hedged, you lost 1.4%, not 7%. Over here, it went down about 12, almost 13%, and if you were hedged, you lost 1.3%. So why I put these all on one sheet is that sometimes when you're hedged, you don't make any money at all. So we didn't make money in technology, but what do we do in the semiconductor? We're up almost 40%, and these are hedged I'm talking about. Home building, you're up 0.7%, which is nothing. Don't forget the S&P is up about 11% when we did this. But down in home construction, if you're hedged, you're up 11.4%, and in healthcare, you're up 15.5%. Transports, you're up 26%, and these are hedged. So this is why when we form a portfolio, we suggest that you use 5 or 6 or even 7 ETFs, because sometimes you're so well hedged you don't make any money, but then in others, you're making money. So as long as you're in more than one ETF, and it's easy because you're only using 5 or 6 stocks from each ETF, so it's not an overbearing portfolio. And let us see how that works when you put them all together in those 6 ETFs. The most you would have lost was 5.1%, but look how much you made over that time. This is totally hedged. These are the top stocks not hedged. So the difference is with these ETFs, if you didn't hedge, you could have lost almost 28%. But look what you would have made in those other years. Now, if you're totally hedged, the most you lost in the past 5 years is 5.1%, and you're up well over the S&P 500. Now, let's look at some other ETFs. Let's look at those original 6 ETFs we were looking at. The most you would have lost the worst year is 4.3%, and you averaged a 15.2% gain, where the S&P was up 13.7%. But the maximum loss on the S&P 500 was 19.5%. On the QQQs, the NASDAQ, you could have lost 34%, and this is 2022. So bottom line is you're losing in these 5 years, you're losing much less than the S&P. The S&P lost 19.5%. The most you would have lost if you had these 6 ETFs, or the top 5 stocks in these 6 ETFs, most you would have lost was 4.3%, and you would have gained more than the S&P. Remember, 96% of the money managers who manage the publicly traded mutual funds, 96% cannot outperform the S&P 500 over any 10-year period. Here you are outperforming, but you're not taking the risk of the S&P 500. Now, had you not hedged, you would have lost maximum in 2022 23%, but look at the average return you would have gotten per year, 47%. So if you want to be hedged and you don't want to lose much money, you can average, or you would have averaged in the past 5 years, a 15.2% return, better than the S&P 500. The S&P 500 lost almost 20%. The most you would have lost in these past 5 years, 4.3%. Now, don't forget, past results have no indication of future results. Okay, so you have to remember that. Even with newsletters, we want to tell you that the past does not have any indication of the future. And so, same with the unhedged portfolios, you could have lost 23%, but there was one of the portfolios, the semiconductor, where you could have lost 42%. That's why you get the top 5 stocks in more than one ETF. You want to get 5 or 6 or 7 ETFs so that you can average out the losses and average out the gains. So this is your choice. You could be half hedged, and then you would be between these numbers. You might have lost 11, 12, 13%, but you would have made about 30%. So that's the trade-off that you have to make for folks. Do you want to be totally hedged, or do you want to be partially hedged, or do you not want to be hedged at all? If you're younger, you can stand these drawdowns as long as you have top stocks in more than one ETF. So, folks, we had a pretty, well, I want to say it was a tough week up until Wednesday afternoon. And then Thursday, we got a nice rally. Friday, the market's not closed yet. It's playing around. And we'll see what happens next week. We'll see if those intermediate term indicators can turn up. So, folks, go out. Have a good weekend. Have a safe weekend. Go out for a walk. Be with your family. Eat a lot of food. Just be happy. Be safe. And, folks, we'll see you back here on Monday.